Hey guys, David Robinson here. Welcome to the Lead Sponsor Podcast. Really excited about our episode today. As always, we've got another great guest for you. I have Karl Krauskopf coming on the show with me today, and I'm excited to share with you his journey into the real estate space. He is an individual that came from a corporate background and got involved in small multifamily, acquired a small multifamily project or a property outside of his local area to sort of dip his toe into the real estate investing space, and sort of caught fire at that point in time and decided to get into the flipping space. Really had a lot of success in flipping while he was still working his corporate career. And ultimately, that helped him to exit his corporate career and go into real estate full time, where he's focused on small scale development projects in the Seattle, Washington area. We talk in detail about how he structures his deals. Typically, he's looking for small townhome projects where he can go and add value into urban areas. And we talk about how he structures those and how he uses the real estate syndication model, 506B syndication model, on these small projects and pairs those with hard money lenders. And so that was an interesting conversation that we had about that. And also why he's adding multifamily, larger scale commercial multifamily value add projects outside of the Seattle, Washington area to help his investors participate in some additional depreciation and some additional benefits of being involved in those type of projects. So great conversation with Karl. Really enjoyed the conversation I had with him, and I think you're going to learn a ton from this episode. So look forward to sharing this with you, and we'll dive right in. All right, Karl. Well, thanks for joining me today. I'm excited to have you on the show. And before we get started, why don't you just back up, give us a little bit of an introduction, a little backstory into, your journey into the real estate space, maybe a little bit about what you've done in the past and how you got involved in real estate.
Sure, absolutely. So, the history of getting into real estate was an interesting one that I worked a corporate job 50, 60 hours a week. My wife was an educator. She worked as a school counselor. So you could effectively look at a 10-year schedule and say, okay, I know what her salary is going to be like in 10 years from now, presuming there's no massive increases. I could look at my income is, as a corporate job, typically you're based on promotions and bonuses is going to be a large part of your compensation and lifestyle package. And you could, typically the case is an 18-month, maybe 36-month turn of work, work hard, work hard, work hard. And then you typically get your payout in anywhere from 18 to 36 months from a promotionary standpoint. And so, we were at this juncture in our life where we were deciding to have a kid. So we were looking at our top line, our income base, and then we were looking at our bottom line, our expense base. We saw a big shift in the expenses, but no shift in the income. There was substantive shift in the income, I should say. And so kind of had this epiphany of like, well, what are we doing? How am I going to get more money? It's an income issue, not an expense issue at this point. Somebody introduced me to the idea of owning small multifamily. Had no idea about that. So I spent about 6 months. First off, I spent about an hour listening to a podcast and fell in love with it immediately. Then subsequently spent 6 months self-educating, reading every single book that I can get my hands onto, listening to every podcast, Audible, whatever it happened to be. Went to networking events and just really, truly tried to absorb as much information as possible before making my first step. And that first step was small, right? It was buying a out of state small duplex. And initially it was a terrible, terrible situation, but I became addicted, right? It had to deal with winter tenant placement in Eastern Washington, Northeastern Washington. And so it was very challenging, all while we had at this point a newborn. So it was definitely a challenging time, but realized through the thick of it, absolutely fell in love, found a passion, and found that the passion could actually generate income to some degree at that point. Decided I needed to get out of that small multifamily business and start increasing capital, bumping up capital. So I started flipping homes and found that I was particularly successful at that. And to make mention is we're based all here in Seattle. And all of our business right now is in Seattle. We have some down in Tucson, Arizona as well. But started flipping homes in Seattle, was wildly successful at it, was still working my 50 to 60 hour a week day job, and did that for about 2 years, you know, I flipped about 12 homes in the course of those 2 years while working the job, and after that, decided it was time to take the side business to the main business. Quit my day job, got into development pretty quickly at that exact same juncture, and now we are 13 units. 13 units. So it's been about a year since I've been full time. 13 units, and we've got another 45 in the pipeline, and about 66 in apartments. So super excited to be here.
Great. Well, thanks for that background. I want to dive into a few pieces of it. First and foremost, what was it? You said you bought this small duplex out of state, and you felt like that was, the right place for you to begin your real estate investing journey.
Sure.
It sounds like it was a bit of a hassle and headache and challenge, but you did mention that you became addicted after this. So what was it about that experience that sort of helped you to catch the fire or the vision of what, could eventually become your career?
I think what it was that lit the fire was seeing an issue, or seeing a potential, I should say, right? A potential of being able to cash flow, being able to pull out cash and then eventually sell for a profit at some point. And then also also pairing that, I should say, with the necessary renovation. So figuring out, from a value engineer standpoint, what is the least work that we could do in order to get the most benefit from a financial standpoint, while factoring in there the quality of life for the tenant as well. Quality of life obviously goes into how long they stay, which in turn reduces turnover costs, so forth and so on. So I think it really was, looking at what the potential of the property had. What can I do to obtain that obtain that potential, and how can I do it in the least kind of the least work effort possible for me. Again, given that this was a 4-hour drive, 4 hour each way, so it wasn't like I could go out there on the weekends or after work each day and fix it up myself.
Yeah. And I'm curious, why decide to purchase something out of state? You bought the duplex out of state, you mentioned.
Yep.
Why not buy in your backyard, maybe something closer? What was it about that caused you to go outside of your, geographic area?
Sure. So at that point, I did not have a lot of disposable income to be able to put into a rental or a project, I should say. And being that I was hyper inexperienced from a real estate perspective, I knew that I wouldn't be able to go out, and I felt that I couldn't go out and raise capital from friends or family or anybody else because, well, I didn't have the experience enough to actually acquire and operationalize and execute on a project.
Yeah. Okay. Makes sense. All right, so let's fast forward then. Today, you had a very successful juncture in flipping homes while working your full-time career. You've eventually quit your day job after having some success in the flipping space, and then you decide to get into development. Why? I think I can bridge the gap. I mean, flipping is sort of the next, the second phase of a development project. I mean, but what caused you to decide to go into development,
Sure.
Full-fledged development, versus just saying, "Hey, let's continue doing what's working, which is flipping homes"?
Sure. So the number one reason for me was scalability. Scalability, both from my own equity standpoint as well as investor standpoint. So when you look at an individual flip, and right at the point that I started to get into development, I wasn't hyper involved or aware of funds, in starting a fund and how that can actually work within a flipping world. So to be fair, this was prior to me knowing and understanding that process. But for me, it was, again, scalability. So scaling my business, bigger dollars meant bigger margin. Yes, bigger risk, but so long as we're actually going through the underwriting process, and a lot of our conservative approach is to not bake in appreciation in any of the actual sales, but simultaneously also baking in inflation. So what does that end up actually causing? How does that impact our business model? Is we close on, or rather we offer and we close on fewer deals because we want to make sure that we're coming in at it from effectively a home run standpoint, really wanting to be able to get in, get the project stabilized, operationalize it, and execute it at or above targeted returns.
Got it. So, pushing forward to what your business, looks like today and what your focus is, there's really, it seems there's two aspects to your business model. The development in your backyard. You
Right.
mentioned that you are based out of Seattle, Washington. So the vast majority, if not all of your development deals are what we would consider small development deals in your geographic
Yep.
area, correct?
Right.
And then you've also added starting to buy larger scale commercial multifamily projects outside of your geographic
Right.
focus. Is that correct?
That's absolutely right.
Okay, perfect. So let's hone in on the development aspect of your business and maybe walk us through what are you looking for in a development project and maybe just walk us through the basic steps of a development project for
Sure.
you.
Yeah, absolutely. So one of the biggest areas, one of the biggest things that I'm looking at from a development standpoint at this juncture now is utility and accessibility. So utility being, now having gone through a couple of these developments, I've realized that the most challenging part of the construction and development process is actually the utility, the civil planning, designing, and execution. And that's because a lot of times you're dealing with these third party entities, and they're changing their staffing. They're either going to be short on staff, or their policies are continuing to change, which impacts the way that we actually connect to the utilities. And so it's continuing to stay on top of and being educated on their processes, as well as managing the construction itself. Managing the construction itself is fairly straightforward and easy, right? I think the most difficult thing that we had happen from a construction standpoint in the last year was we had a concrete strike. The concrete strike up here in Seattle lasted for about 3 months. Now, for better, we ended up pouring all of our stem walls, no joke, the week before the strike began. So we were able to get in, get our concrete done, and completely avoid any impacts of the concrete strike, which was a huge win for us. A lot of other developers did not have that success. So many of their projects either A, stalled, or B, they had to go to smaller concrete operators, right? Privately owned, non-unionized concrete workers, and pay somewhat of a premium in order to get their projects continued.
Hmm.
So again, from the construction standpoint, not really looking for anything in particular. Really, it's how do we get the utilities? How do we manage and work with the city from a Department of Transportation standpoint? Correct, in the inspections and construction department with the city, et cetera. And are there any issues that we can foresee that could be coming up? Right. To give you one more example, from a utility standpoint, is ensuring when you're going through the underwriting, when you're going through the permitting and entitlements of the project, is doing some baseline understanding of the electrical grid, electrical system. And one super easy way to do that is look at the power lines and how old does the transformer look? Does
Hmm.
it look archaic as compared to maybe some of the other areas in town? And if so, you'll probably need to work with the electric company to have that replaced. And that usually costs time and money. Whereas if you're in an area that is already being developed rapidly, typically the electric companies will have already upsized their transformers. So that way you can go in, connect relatively quick, and move on your happy way.
Hmm. And you mentioned, just the challenges of working with these municipalities and getting these developments approved. Is there any strategies or tactics that you've learned or developed in your efforts with new development in communication or just getting your projects through
Sure,
approval?
sure.
Any strategies that you might be able to share with our listeners?
I would certainly say relationships with anybody within the municipality or utility companies is just making sure that you're maintaining and respecting the relationships with those individuals, and that you're not just bulldozing or bulldogging your way through each and every development. Because if you are, if and when, I should say, when you need any kind of favors or when you need anything expedited, where you shouldn't need it expedited. And the city, again, if you're maintaining those relationships and cherishing, or rather nurturing, that's a better word, nurturing those relationships, then when that time comes, you can certainly be more in favor of getting your way. So
Hmm.
I would say nurturing relationships within the city, understanding the processes, understanding the hierarchy is a good thing to do. In Seattle, we do have published hierarchies. We do have published org charts within the city. And so knowing and being able to work around those, if you're hitting a roadblock with your current electrical services representative, then it's an easy way to go in, find out who the supervisor is, even if they won't tell you, find out who the supervisor is and start looping them in.
Yeah, great tips. So I want to touch base real quick on what you're focused on. What are you looking for in an opportunity? Like, what's the end product goal
Sure.
for you?
Sure. So right now, on the development side, it's making sure that we have two hyper competitive options from an exit strategy perspective. It's making sure that our build to sell models are juicy, right? Have enough capital to be able to return healthy returns back to investors as well as ourselves, and simultaneously while also having a healthy buy to rent model as well. And so that's typically going to be in areas that are dense with uh, amenities or light rail, which is the mass transportation here in Seattle, making sure that end buyers or end renters are going to have access to really truly the things that they want from a living in the city perspective. Because again, a lot of our developments right now are townhomes, and these townhomes are in urban areas, right? The other model that we haven't explored yet is the larger single family buy to rent, or build to rent further out in the suburbs. But we haven't explored that yet. Obviously, I know a lot of other operators are successful in that model. But right now, I think my heart goes out to the people that are living in the city,
Mm.
right? Those are going to be low, middle income service workers who really truly do need to still, their jobs are in the city. And being able to provide them affordable housing has been something that really speaks to us ethically or morally, I should say,
Mm.
and being able to impact and bring in investors that want to do impact investing and bring in quote affordable housing to these families in urban areas.
Yeah. And so this small development, townhome style, doesn't sound, it sounds like your typical project is a townhome project. How many units typically are you looking to put on
Sure.
a project?
So typically it's anywhere from five to eight townhomes per lot. Now we've been getting closer and getting into the assemblage style. So 5 to 8 per lot, and tying in three of those together.
Hmm.
So that way we're effectively 15 to 24. Hopefully that math is right. 15 to 24, it's roundabout.
Yeah.
And that style is going to be a lot more effective from a economies of scale perspective,
Mhm.
specifically from, again, a lot of the utilities. So we'll see a lot. We would see a lot of savings in the utility side, um, a lot more than on the actual construction side.
Yeah, makes sense. So let's talk a little bit about how you structure these type of deals from a debt and a financing perspective. Maybe walk us through that.
Sure. So our typical so far, I should say, has been 506B, so family friends syndications, and we'll raise the equity. We'll go in, tie it in with typically in the past it's been hard money. So coming in with hard money where we can operationalize and close within, let's call it 30, maybe 45 days at most. And points, relatively higher. Obviously, interest rates are higher, and still everything's hyper competitive. And I think finding and identifying the most successful lender from the ground up construction standpoint has been something that's been really successful for us.
Real quick, I'm curious.
Yeah.
I just don't want to leave the hard money question first. What typically what is the hard money partner or the hard money lender looking for in your project for them to be interested in that type of project?
Sure. So it would, I mean, from a numbers perspective, it's going to be 65% loan to value. So they want to look at what's the exit value, whether it's a broker's opinion or if it's, that's obviously first toll gate, second toll gate is making sure that it corresponds back to the appraisal.
Mm-hmm.
So it's a 65% loan to value, making sure that, the whatever the end value is, we want to be 65% or below it. And that's in order to get favorable loan terms, such as 85% loan to cost. As those two ratios fluctuate, obviously you can become more aggressive on the lending or more conservative on the lending as well.
Okay. And as far as the equity that you'd be bringing to the table, and just from a logistics standpoint, when you're using hard money to close in 30 to 45 days, are you then formulating your syndication structure up front, raising equity into the syndication, and then using that equity as that other roughly 35%?
That's exactly right.
Okay.
And I want to make sure. So the 35%, it wouldn't be 35%. It would be the 15%, right? From a loan, because the loan is going to be based
85.
on
Okay.
actual cost, right?
Yeah. Great. And then I assume, are you building in you're building in the construction cost to that as well? That's
exactly
okay.
right.
Got it.
That's exactly right.
All right. Perfect. And so, what are some unique challenges? A lot of, let me clarify my question here. I've got a few things running through my mind. What I'm wondering is many of our guests who come on are existing value add syndicators,
Sure.
right? Operators. So they're coming in and they're structuring a syndication for a project that's already there. You're raising equity for a project that will become, right? Yep. What are some unique challenges that you face as a developer who's also syndicating deals as it relates to raising the equity?
I would say two things. A, it's substantiating and being hyper confident on the exit values. Obviously, that's no different than on a value add side. A little, obviously, the difference is it's speculative, but again, that's where we go. That's what the comment was earlier in terms of, whenever we project end value, it's going to be based on recent sales. And so it's a little bit different it's quite a bit different than on the larger scale value add apartments, because it's not NOI based. It's based on actual comparable sales. So again, we're able to go in and say what we believe the exit value to be, so long as the market holds at its current value. So obviously there's some fluctuation that could happen, especially in this next 1 or 2 years. But we're still hyper confident. We're bullish on the Seattle market for that reason.
Yeah,
I think one of the other challenges is cost of construction. Obviously, still has to be dealt with on the value add side. But given that the vast majority of our cost basis is going to be held in the construction side, any amount of increases or unforeseen expenses really do start to tack away at profitability. Now we've been able to secure favorable terms with contractors, and I would say the most important one is to obtain lump sum guaranteed max price contracts on the developments. And so, one of the biggest things that I've noticed and that we've come across is that not many contractors or general contractors in this case want to sign up for a guaranteed max price contract, because, well, they can't predict what's going to happen to lumber, right? And if they tried to, they would have to inflate their fee so much that it probably wouldn't become reasonable to even bid it.
Yeah.
And so, what we've started doing is, okay, that's fair. Let's do some carve outs. What are the commodities that have changed radically over this past year, right? It's going to be glass, mirrors, shower doors, windows, things like that. It's going to be flooring. Flooring has gone up dramatically, specifically LVP, given that it's a petroleum-based product. Others are obviously lumber, as we all know. And so it's finding and carving out those particular items, having those on their own cost plus margin contract, with everything else being on a guaranteed max price. And so we found some traction there that's allowed us to hedge ourselves and allows the builder, general contractor, to de-risk their own contract as well. So it seems like it's a win for our investors, because we're able to get to a more predictable contract price. It's a win for us as well. And then it's a win for the contractor, because they have little to no risk in the deal.
Yeah, makes sense. Before we leave your development stuff, help me to understand, maybe walk us through when you would take out the hard money. At what stage do you take out the hard money lender and go into longer term financing?
I'm hoping on this very next deal. So we've got one that we are under contract on right now. We're slotted to close late, maybe midsummer actually. And we're working with a local bank on that particular project. And the reason being, and I think this goes back to your question, is the reason being is I am so bullish on the build to rent model that that's plan A. Plan A is build to rent. And so they're able to offer that construction to perm debt, whereas the hard money, not so much, right? Their number one bread and butter product is spec home building, right? Your terms are, they are what they are, 12-month term, 18-month term. And there's no, in order to refi, it's going to be point extensions, and they don't necessarily have a product to refi you into that has favorable interest terms.
Yeah. So let's transition a little bit and let's talk about number one. I'm curious, why add existing value add multifamily to your buying criteria outside of your
Sure.
local market? Like, why not stay focused on your bread and butter, which you've developed a pretty good system for,
Yep.
have had success with? Why reach beyond, Seattle, and get involved in larger commercial multifamily
Sure.
value add deals?
So we're still certainly working within the realms of Seattle from an apartment standpoint. Not just
So
Seattle, but
you are looking for product
yes,
for okay, great.
yes. But for the most part, a lot of the investors and a lot of people in general know that Seattle is not hyper landlord friendly, and so it's a little bit tougher of a sale. It's going to be a tougher management, and that just spells probably not the best scenario. So yes,
Just
Seattle is
a
still
just a bigger challenge for raising equity for that type of
exactly,
deal, correct?
exactly. So Seattle's still on the radar, but there's plenty of other markets around Seattle, from Everett, Bellevue down to Tacoma. So the entire Puget Sound region, which is still seeing a ton of population and job growth, in that we are still absolutely underwriting. We're looking for value add deals here, specifically redevelopment deals. And so this kind of goes back into the conversation of sticking with the bread and butter of development, but also tying in that value add aspect. So redevelopment being, it's a multifamily, it's an asset that's sitting on land where the current asset is underutilizing the value of the land, right? So for instance, there's a 8-unit flat, super old multifamily building on this large lot of land that's zoned for mixed use. And so
Mm.
the play here that we're working working on is redeveloping it for a 3 commercial space, ground floor, and 35-unit apartment complex.
Mm.
Those types of deals, they take long, right? They're 3 to 5 years before you finish the actual redevelopment, the entitlements, and construction of it. So those are way out. Those in that particular one we just started earlier this year. So not going to see a whole lot from there. But on those instances, right, we're still working the light value add. We're not pushing things too hard, but we're getting to a point where we want the rent to offset or cover the entire debt service.
Mm.
So cash flow is going to be low on those.
Yeah.
But I think your question is really, I want to get back to
Well,
that
I'm
is,
just curious. Well, thanks for covering that, but
yep,
I'm also curious about why you decided to go into multifamily,
yep,
existing value add multifamily versus
outside.
staying in your lane.
Ah, okay, I hear you. So one of the big reasons is from a depreciation standpoint, right? On the development side, unless we're holding them, there's not a whole lot of depreciation. There's just a whole surge of capital into it, and capital gains. Tax perspective, a lot of the investors that we work with are either retired or they're working outside of within their SDIRA, self-directed IRA, and so they want other areas to offset. They want investments to offset income, offset gains, and so we're just not seeing that on the development side. And the multifamily apartments is just gold, right?
Yeah.
It's perfect. It was built for it.
Yeah. And have you exited any of your development deals yet? I know you've
Yes.
third. Okay.
Yep. So we just
And
exit. Go ahead.
and I'm just curious about the exit strategy. Is it, hey, exit, get a good lump sum, pay out the investors, or are you trying to look for opportunity to exchange into something new?
That's a good question. That is a really good question. And so far, it's just been capital out and then reinvest it back in, not via 1031.
Yeah.
But I think that's going to work a lot better on the individual sales. So, right now, a lot of the townhome sales are going to be individual, right? So for the sixplex or
Uh,
six townhomes that we just sold, that's six individual sales. So
mm,
lining up six individual or 1031s on those into another asset is going to be difficult, a
yeah,
lot more
for
challenging, a
sure.
lot more logistically challenging. So certainly when we go into selling one asset and moving that money into another asset, absolutely 100% will be working on 1031.
Got it. Makes sense. So, as it relates to your value add projects, you mentioned that you have a deal that you've worked on and acquired in Tucson.
Yep.
What is it that you're looking for in value add opportunities? What kind of projects are you looking for?
Sure. That's a great question. I think one of the big ones is obviously along the lines of my passion, which is adding density. So, one of the big things that I look for is how can we add additional units? How can we add additional income streams that are not currently on the T12? And so, obviously, that's going to be is there space? Is there a basement? Is there extra land that we can actually add? So, that's one of the ones that I really, really love hone in on and we try to get in and close on.
Hmm.
Obviously, there's a lot of things that we need to figure out during a feasibility period that would determine whether or not we could. And so, again, going back to the conservative underwriting, we always assume the least that we're able to do the least amount of unit additions or income additions. And so, again, that's first. Second is really looking for, and I'm not sure how many of these still exist, pre-pandemic rent increases, right? So rent increases that have not been done since
Hmm.
pre-pandemic, and really focusing on capturing that loss to lease. And then from an operational side, is looking to identifying the mom and pop style management where I was just at an apartment earlier in April, and the owner, God bless him, is taking out tenant trash. He's out there still painting the exterior of the building. And there's just a lot of operational deficiencies that really lead back to lower rent, lower income,
Hmm.
lower ability to capture again a lot of that income stream. So finding those style is really what we're looking for.
And what has it been like transitioning from investing in your own backyard? Well, this is a two-part question. The first
Sure.
part is, are you partnering with local operators in these markets that you're seeking out?
Absolutely.
Okay. And now knowing that, what has it been like going from, hey, you're basically running the entire deal in your backyard in Seattle to maybe playing a different role in
Yep.
projects and opportunities that are outside of, your main control?
Yeah, it's been challenging. I'll just be absolutely forthcoming there, and which is why we've only been able to acquire one asset outside of our space within the last year. And I would say that the biggest thing that we're looking for is previous relation. Ideally, it's a previous relationship where we've already gained that. We already know them, we already like them, and we already have some degree of trust with them. And so then it's sparking the business conversation around, well, how can we make something work together? Whether it's them managing, working on the asset management side or whatever it happens to be from their role, is really understanding what are they good at, what are we good at, and how can we work together. And so that's why the other reason is we have a very, very small market list that we're actually targeting, looking for apartments in, and we're not just spread all over the country looking at every single possible deal. There's just not enough time for that.
And do you already have relationships built in those target markets, or do you want to give a little shout out to the markets that you're looking for?
Yeah. So the first answer is yes, is absolutely. We do have relationships, and that's why one of the big reasons why we've identified and worked with them. Second is sure. So we're working in Salt Lake City. We're working in Southeast. So think of Georgia, Raleigh, and some of the secondary markets around Raleigh, and then the triangle down in Florida, which would be the Tampa, Jacksonville, West Palm Beach area.
Got it. Okay. Perfect.
Yeah.
All right. Well, I want to start winding down here. I've kept you for a while, and this has been a great conversation. Really enjoyed learning more about your business model and what you're looking and how you're pairing the two. Before we start to wind down, a few final questions for you. The first is, what's the biggest challenge that you're facing right now in your business that we could all learn from?
Sure. So yeah, it's market based. So it's going to be the interest rates, the rising interest rates from from the apartment side of things, and making sure that we're able to go in and we're able to secure the appropriate level debt that allows the investor returns that we need, and also able to match expectations from the seller side of what they want from a sale perspective. So, right now it's just been a lot of mismatch on pricing, and just solely because we're only able to offer what we're able to offer based on achieving investor returns.
Yeah. And what's something that you're just knocking out of the park right now in your business that you're doing really well that we could all learn from?
Sure. I think it's relationships and just understanding and being able to get closer to, whether it's investors, whether it's debt funders or construction individuals, is really truly being able to be present in the moment while you're having conversations and really genuinely caring about what the other person has to say. And so I think that has served me very well, served Aurora's Investment Group very well, is being able to just go in again and just being super transparent, super genuine, and really interested in building those relationships with individuals, whether it's, again, equity, debt, construction, whatever it happens to be, whether it's an industry stakeholder, just making sure that, again, you're working on building that relationship.
Yeah, makes sense. Well, Karl, this has been a great conversation. I appreciate you coming on, spend some time with us, giving us some insight into your background and how you got into the development space, and a little bit around your business model and how some of the tips and strategies and working with municipalities and how you structure your deals, even utilizing the syndication model on smaller development deals, and then how you've added larger scale commercial multifamily value add deals into sort of your offerings so that your investors can participate in a little bit more depreciation than your development projects can offer up. And so great business model. Really enjoyed our conversation. Before we let you go, what's the best way for our listeners to connect with you and learn more about what you have going on?
Sure. So happy to reach out to me via our website, www.aurorasinvestmentgroup.com, as well as reach out to me directly, Karl with a K, Karl at aurorasinvestmentgroup.com.
Awesome. We'll have that in the show notes. If you've enjoyed our conversation with Karl today, go down in the show notes, click on one of those links, and connect with Karl and his team. Thank you again for coming on, sharing your journey with us, and I look forward to staying in touch with you down the road.
Likewise.